What if every banking crisis in recorded history, from the medieval collapse of the Bardi and Peruzzi banks to the 2008 financial meltdown, followed the exact same five-stage pattern? A pattern so precise, so predictable, that you could set your watch by it? And what if I told you that right now, at this very moment, the American banking system is exhibiting every documented symptom of Stage 4, the stage that, without exception, has always preceded catastrophic systemic failure? This isn't speculation. This is pattern recognition. And the pattern has never been wrong. For the past 8 centuries, banking collapses have followed a remarkably consistent five-stage progression. These aren't random events scattered across history. They are the predictable outcome of identical structural weaknesses playing out with mechanical precision. Stage 1, the innovation phase. A revolutionary financial instrument is introduced: bills of exchange, fractional reserve banking, mortgage-backed securities. It creates enormous wealth. Everyone celebrates the genius of the innovators. Stage 2, the proliferation phase. The innovation spreads rapidly. More banks adopt it. Regulatory frameworks lag behind. Risk becomes systematized, baked into the foundation of the financial architecture. But nobody notices because everyone is making money. Stage 3, the overreach phase. Banks, now confident in the new paradigm, begin taking increasingly aggressive positions. Leverage ratios climb. Risk management becomes secondary to profit maximization. Warning signs appear but are dismissed as pessimism from those who do not understand the new model. Stage 4, the fragility phase. This is the critical inflection point. Small cracks appear. A regional bank fails. A credit instrument underperforms. Liquidity concerns emerge. The system is now extraordinarily fragile. It appears stable on the surface, but a single shock can trigger cascading failure. This stage can last years, even decades. But it always leads to Stage 5. Stage 5, the collapse phase. A triggering event, a war, a pandemic, a political crisis, or simply a loss of confidence, exposes the systemic rot. Banks fall like dominoes. Credit freezes. The real economy convulses. Governments intervene, but often too late. The aftermath reshapes the financial landscape for generations. Let me show you how this pattern has repeated itself with disturbing consistency across 800 years of financial history. The Bardi and Peruzzi banks. Florence, 1345. In the early 14th century, Florence was the financial capital of Europe. The Bardi and Peruzzi banking families had pioneered a revolutionary innovation, lending enormous sums to monarchs, secured against future tax revenues. Stage 1. The model was brilliant. Kings needed capital for wars. Banks earned extraordinary returns, and everyone profited. By the 1320s, every major Italian bank had adopted the model. Stage 2. Credit flowed freely across Europe. The Bardi and Peruzzi became the largest financial institutions in the known world, with loans extending from England to the Kingdom of Naples. But by 1340, the banks had become catastrophically overextended. Stage 3. The Bardi alone had loaned King Edward III of England 900,000 gold florins, an astronomical sum representing multiple years of English tax revenue. They had bet everything on the English crown's ability to repay. Then came Stage 4. In 1340, Edward defaulted. Not a partial default, a complete repudiation of his debts. The Bardi and Peruzzi were immediately rendered fragile. They scrambled to recall loans, sold assets at distressed prices, and desperately sought liquidity. For 5 years, they teetered on the edge. Stage 5 arrived in 1345. A cascade of smaller defaults across Europe triggered a panic. Depositors rushed to withdraw funds. The Bardi and Peruzzi collapsed within months of each other, taking down nearly every major Florentine bank with them. The financial system of Europe ground to a halt. It would take a generation to recover. The five-stage pattern was complete. The Amsterdam Whistle Bank, 1609 to 1820. Fast forward 2.5 centuries. Amsterdam had become the new financial capital of the world, anchored by the Whistle Bank, the Bank of Amsterdam, founded in 1609. The innovation this time? Stage 1. A public bank that accepted deposits and issued transferable credit, creating what was essentially the first modern fiat currency backed by municipal guarantee. Merchants could settle debts by simply transferring bank credits on the Whistle Bank's ledgers. It was revolutionary. Amsterdam became the wealthiest city on Earth. Stage 2. By the mid-1600s, the whistle bank model had become the template for banking across Europe. Credit expanded. Trade flourished. The Dutch Golden Age reached its zenith. Then came Stage 3. By the 1780s, the whistle bank had secretly begun lending its depositors' funds to the Dutch East India Company and the city government, a direct violation of its founding charter, which promised 100% reserve backing. The bank was now fractionally reserved, leveraged, and deeply exposed to geopolitical risk. But the ledgers remained opaque. Nobody knew. Stage 4 began in the 1790s. The French Revolutionary Wars destabilized European trade. The Dutch East India Company's profits collapsed. Rumors began circulating about the whistle bank's true financial condition. Sophisticated merchants started withdrawing their deposits, quietly, without fanfare. The bank was fragile, still functioning, but hollowed out. Stage 5 came in 1820. After decades of slow bleeding, the whistle bank finally admitted it was insolvent. Its reserves had been exhausted. The bank that had underpinned 2 centuries of Dutch financial dominance closed its doors. Amsterdam would never again be a major financial center. The pattern had repeated. The London banking crisis, 1825 to 1866. By the early 19th century, London had replaced Amsterdam as the world's financial hub. British banks had pioneered a new innovation. Stage 1. Joint stock banking with limited liability, allowing them to raise enormous amounts of capital and expand credit on an unprecedented scale. Stage 2. The model proliferated wildly. Between 1810 and 1825, hundreds of new banks were chartered across England. Credit exploded. Speculation ran rampant in South American mining stocks, real estate, and government bonds. By 1825, Stage 3 was in full effect. Banks were lending against assets of highly questionable value, with minimal reserves. The Bank of England itself held only £1.2 million in gold reserves against liabilities exceeding £20 million, a reserve ratio of just 6%. Stage 4 arrived in December 1825 when a major bank, Pole, Thornton and Company, collapsed, triggering a panic. Within weeks, 73 banks failed across England. The Bank of England itself came within hours of insolvency, saved only by a last-minute shipment of gold from the Bank of France. The system stabilized, but the fragility remained. Over the next 4 decades, Britain experienced repeated banking crises. 1837, 1847, 1857, each one a near miss, each one reinforcing stage 4 fragility. Stage 5 finally arrived in 1866 with the collapse of Overend, Gurney and Company, the banker's bank, one of the most respected institutions in London. Its failure triggered a panic so severe that the Bank of England was forced to suspend convertibility of currency into gold. The British banking system was restructured from the ground up. The pattern, once again, had completed its cycle. The 2008 financial crisis. Now let's examine a collapse within living memory, one that follows the pattern with textbook precision. Stage 1. The innovation was mortgage-backed securities and collateralized debt obligations, complex financial instruments that allowed banks to bundle thousands of home loans and sell them as tradable assets. It was hailed as a triumph of financial engineering, a way to spread risk and unlock capital. Stage 2. By the early 2000s, every major bank on Wall Street was deep into the MBS market. The model had proliferated globally. Deutsche Bank, UBS, Royal Bank of Scotland, they all adopted it. Trillions of dollars in mortgage debt were securitized and dispersed throughout the global financial system. Stage 3 arrived by 2005 to 2006. Banks were now writing subprime loans to borrowers with no documentation, no down payment, no realistic ability to repay, because they could immediately sell those loans into the securitization pipeline. Lehman Brothers was operating with a leverage ratio of 30 to 1. Bear Stearns, 35:1. They had placed an enormous bet that housing prices would never decline. Stage 4 began in 2007. Small cracks appeared. Subprime lenders like New Century Financial collapsed. Bear Stearns liquidated 2 hedge funds. But the major banks insisted the problems were contained. The system looked stable. Underneath, it was catastrophically fragile. Stage 5 detonated in September 2008. Lehman Brothers collapsed. AIG was hours from bankruptcy. Washington Mutual failed, the largest bank failure in American history. Wachovia was forced into a shotgun merger. The entire global financial system seized up. Credit markets froze. The Dow Jones plunged 777 points in a single day, the largest point drop ever recorded. Only a $700 billion government bailout and unprecedented intervention by the Federal Reserve prevented total systemic collapse. The pattern had repeated. Again. So where are we now? Let's methodically apply the five-stage pattern to the current American banking system. Stage 1 occurred in the 2010s with the innovation of ultra-low interest rates and quantitative easing. The Federal Reserve held rates near zero for 7 years, flooding the system with cheap money. Banks gorged themselves on long-duration treasury bonds and mortgage-backed securities, earning a small but seemingly risk-free spread. Stage 2. The model proliferated. Regional banks across America loaded their balance sheets with these safe government bonds. By 2022, U.S. banks held over $4.4 trillion in securities, much of it long-dated debt purchased when rates were at historic lows. Stage 3 arrived when the Fed began raising interest rates in 2022, the fastest rate hike cycle in 40 years. Those safe bonds lost enormous value. A 10-year Treasury purchased at 1% interest in 2020 had lost 20 to 30% of its market value by 2023. Banks were suddenly sitting on hundreds of billions in unrealized losses. But as long as they didn't have to sell those bonds, they could pretend the losses didn't exist. Stage 4 is where we are right now. March 2023, Silicon Valley Bank collapsed in 48 hours, the second largest bank failure in American history. Its $209 billion in assets evaporated. Why? Because it was forced to sell its bond portfolio at a massive loss to meet depositor withdrawals, crystallizing what had been unrealized losses. 3 days later, Signature Bank failed. Then First Republic Bank, $229 billion in assets, seized by regulators and sold to J.P. Morgan Chase in a midnight deal. These were not isolated incidents. According to the FDIC's own data, U.S. banks are currently sitting on $620 billion in unrealized losses on their securities portfolios. $620 billion. And here's the critical detail. Silicon Valley Bank's collapse triggered a quiet bank run. Within days, depositors pulled $472 billion out of regional banks. The Federal Reserve had to create an emergency lending facility, the Bank Term Funding Program, to provide liquidity and prevent a systemic meltdown. The cracks have appeared. The system is fragile. We are deep into stage 4. But the pattern is not complete. History tells us stage 4 can persist for years. The Whistle Bank teetered for 3 decades. The British banking system experienced repeated crises across 40 years before the final collapse in 1866. Stage 4 is not the end, it is the prelude. What makes stage 4 so dangerous is that it creates the illusion of stability. Right now, most regional banks are still operational. The stock market has recovered. Regulators insist the system is sound and resilient. But beneath the surface, the structural fragility remains. Those unrealized losses are still on the books. The interest rate risk hasn't disappeared. The next shock, a recession, a geopolitical crisis, a sudden spike in unemployment, could be the trigger. And when stage 5 arrives, it will not arrive slowly. Let me be absolutely clear about what this pattern reveals. Banking collapses are not random acts of financial chaos. They are not caused by a few reckless individuals or unforeseen black swan events. They are the inevitable outcome of structural decisions made years, sometimes decades, earlier. The innovation creates the vulnerability. The proliferation embeds the risk. The overreach magnifies the exposure. The fragility makes the system brittle. And then, when the triggering event arrives, the collapse is swift and merciless. Every single one of the historical cases I've shown you followed this pattern. Not some of them. All of them. The Bardi and Peruzzi, the Whistle Bank, the London banks, Lehman Brothers, Silicon Valley Bank. The pattern does not care about technological advancement. It does not care about regulatory frameworks. It does not care about the sophistication of financial models. The pattern is structural. It is mathematical. It is inevitable. And right now, the American banking system is exhibiting every documented symptom of stage 4 fragility. Does this mean stage 5 is imminent? Not necessarily. Stage 4 can last years. But history is unequivocal about one thing. Stage 4 always leads to stage 5. The only question is when. So what should you take away from this? First, understand that the next banking crisis is not a matter of if, but when. The structural conditions are already in place. The unrealized losses exist. The fragility is documented. The pattern is active. Second, recognize that when stage 5 begins, it will happen faster than you expect. Silicon Valley Bank collapsed in 48 hours. Lehman Brothers went from solvent to bankrupt in a weekend. Modern banking operates at digital speed. When confidence breaks, the cascade is instantaneous. Third, and most importantly, understand that this knowledge is your competitive advantage. The vast majority of people will be caught off guard when the next crisis hits, just as they were in 2008, just as depositors were in 1866, just as Florentine merchants were in 1345. But you know the pattern now. You know the stages. You know what stage 4 fragility looks like. And you know, with absolute historical certainty, what comes next. The pattern is clear. The evidence is documented. The warning has been issued. For those willing to look,